Might as well get started. I just wanted to say hello, everyone. Welcome to our webinar this afternoon, titled How Disruptive Technologies Are Enabling the Reopening Economy. My name is Graham Edwards, and I'm the Membership and Mentorship Chair with the CFA Society here in Ottawa, and your host today. The agenda for our webinar will begin with my short and brief introduction, followed by the presentation itself, and then we'll open it up for questions. So you can ask questions using the chat function or the raise hand icon, or just unmuting if you'd like and asking your questions at the end of the presentation. So I'm very happy to have with us today from Global X, Mr. Warner Wen and Mr. Jay Jacobs. Welcome, gentlemen, to Ottawa. Great to see you.
Thank you, Grant.
Actually, our first speaker this afternoon will be Mr. Warner Wen. Mr. Wen is Global X's Canadian representative. He's responsible for the communication and distribution of Global X's ETF products to Canadian financial advisors and institutions. Prior to joining Global X, Mr. Wen, was senior ETV product manager at McKinsey Investments. So following Warner will be Mr. Jay Jacobs, senior vice president and head of research and strategy at Global X. Jay leads the firm's research team and is responsible for providing clients with Global X's unique insights on the markets and ETFs. Jay is frequently cited in the financial media, including CNBC, Bloomberg, and the Wall Street Journal. So Mr. Wen and Mr. Jacobs will provide us with their insights on the challenges facing the reopening of our economies and which technologies will play a critical role in the new normal. So at this time, I would like to turn the webinar over to our first speaker.
Thank you, Graham, and thanks to CFA Ottawa for having us today. And thank you everyone on the line for joining us. We're really excited to talk to you about thematic investing, and especially in this very unique environment. So, to tell you a little bit more about our firm, Global X is primarily an ETF issuer, and we're headquartered in New York. I am personally based in Toronto, as Graham mentioned, but the firm really has a global presence and strong support from our parent organization, Mirae Asset. Today, we have about 24 billion in total ETF assets under management, and more than half of our AUM is in the thematic growth suite of products, as you can see on the slide here. Global X is really committed to being a leader in the thematic space. We currently have the largest number of thematic ETFs in the US market and possibly in the world. We have over a decade of experience developing, building, and managing these thematic ETFs. We also produce a large volume of thematic research content and leveraging a deep bench of the research team headed by Jay. So of course, research is the reason we are all here today. Without further ado, I want to kind of dive into today's topic. But first, maybe I think it's worthwhile to really define what is thematic investing. So if we think about, what considerations investors take into account, before they invest, I think there are, generally speaking, two sets of considerations. The first is really rooted in what we have learned from the past, and many strategies are, based on expectations of historical stock returns or factor behaviors, repeating themselves to at least to a certain extent. The second set of considerations are based on the investor's expectations of the future, and this is where thematic investing sits, and the ideas in thematic investments are forward-looking in nature, and really based on the premises that the future will look different than what we have seen, and they represent paradigm shifts and structural trends we see in the world. So at Global X, we define thematic investing as a two-step process. As you can also see on the slide to the right-hand side, from a top-down perspective, we need to identify disruptive macro level trends which drive themes that we have a lot of conviction in. From a bottom-up approach, we look at the investable universe of companies and create a basket of stocks that give you the pure exposure to the identified themes. So the other characteristic of thematic investing I want to point out is really that thematic investing is by design unconstrained by traditional geographic or sector definitions. So on that last point of being unconstrained, I think that's why it could make thematic investing particularly relevant for Canadian investors. We probably, the people in the room here probably know that on average, Canadian investors have over 20% of their equity assets invested in Canadian stocks. And that is 7 times the weight of Canada if you put it in a broad global equity market index. So this reflects a significant home bias. And, on top of that, we know the domestic stock market, is really heavily concentrated in a few sectors, and really lacking the depth in certain sectors such as technology and healthcare. While there's nothing wrong about Canadians wanting to keep their money invested in Canadian companies, it does potentially limit the efficacy and robustness of their portfolio. And specifically, if you're a long-term investor, such as planning for retirement. And this is maybe a good segue into the next slide here, which discusses our approach to thematic investing. As you can see, the long-term focus is really a key, one of the key criteria in our thoughts when we develop and launch thematic ETFs. So to quickly just highlight our 3-part criteria. Number 1, we must have high conviction in the theme driven by structural changes to play out the way we expect it to. And number 2, the theme must be investable. And this means a basket of publicly traded companies must exist with high exposure to the theme. And number 3, we want the theme to be long-term in nature, multi-decades or even evergreen, so that it makes market timing less of a concern for investors. So now that we've covered the basics of thematic investing, let's talk about the elephant in the room here, which is COVID-19 and its impacts on many facets of our lives, as well as many themes we track. So at Global X, we frame our discussions as the 4 phases of COVID-19, as you can see on the slide here. And I do believe it applies to not only US, but Canada and arguably other parts of the world as well. You have the pre-COVID economy, where we generally knew about the disease and originating in China, but not sure whether or how it would affect North America or the other parts of the world. And then you have stay-at-home economy, which I'm sure all of us are quite familiar with by now, since we have lived through it. And essentially much of the world just shut down abruptly, and within a short few months period of time. And next, you have the reopening phase. And this is our focus today and where we believe we are in terms of the timeline. And this is a very delicate transition period. And certainly some of the characteristics can overlap with the stay-at-home economy. But what you see is more rules, policies put in place by governments, and you see changes in consumer behaviors and business practices all geared towards moving us forward. And the other thing to note is in this phase, we do see the policies and behaviors and conditions change quite quickly. It could change at a moment's notice. So eventually what we want is really get us from here to the new normal. So hopefully with the plans to roll out vaccines and other mitigation efforts around the world, hopefully schools and business can open soon. And the other thing we really want to remind people is we don't think that the newly established rules and some of the practice are going to go away anytime soon. Even in the new normal, some of them will stay for the foreseeable future, at least. So if we take a look back at the stay-at-home economy and that environment, the focus was really squarely on containing the spread of COVID-19. And you got millions and millions of people stay at home, and consumers, employers, students, They all had to adapt to the new reality fairly quickly, and in many cases scrambling to really find solutions to support their typical way of life, be it digital education or e-commerce or work from home arrangements. So because of the abrupt shutdown of businesses and social activities, we did see many industries felt like a destructive force from COVID-19. So that's your airlines, travel, restaurants, brick and mortar retailers. Certainly they have borne the brunt of the hurt. But when you look at some other industries, the velocity and the scale of the shutdown has actually boosted consumer adoption and business operations. So if you're not familiar with the diffusion of innovation theory, it essentially illustrates the adoption of innovation as an S-shaped curve, as you see on the slide here. So you have different cohorts of people adopting innovations or technology at a different time. And as you can see from the chart here, we really believe COVID-19 effectively did two things to this S curve. Number one, it made the curve steeper. So that means the adoption by the majority of people, in many cases, was accelerated for many technologies. And number two, it lifted up the curve. And that means the total potential addressable market has expanded. And we will kind of, use a couple examples to back up this notion of steepened and higher S curve for innovation. So first look at cloud computing. In the first and second quarter of 2020, software as a service or SaaS companies generated positive quarter-over-quarter revenue growth. If you look at the orange bars on the chart here, and that's against the backdrop of the broader market represented by S&P 500 companies losing revenue in those quarters. So I'm sure by now everyone in the virtual room here has tried a few video chat or video conferencing solutions firsthand. But that's a testament to how fast that industry got a boost from the COVID-19 stay-at-home economy. And e-commerce was another obvious beneficiary of the stay-at-home environment. Not only did more people, including, for example, your grandmas, grandpas, either voluntarily or quote unquote forced to shop online, but also you see more categories such as grocery, healthcare products, and home goods demonstrate more sales volume from online channels. And you see businesses pivot quickly to try to catch up on the technology to deliver those solutions to consumers. And in the absence of sports and other entertainment options, people turn to video games to keep themselves entertained, not only entertained, but also socially engaged. So as a matter of fact, the CEO of Activision Blizzard, this is one of the largest video games companies in the world, he stressed the importance of the social interaction aspect of gaming even before COVID-19 happened. So I think that was a pretty good observation. And what we see is really during the pandemic, the social isolations have certainly increased that appeal of video gaming. Now, when we summarize everything we talked about for the stay-at-home economy, the bottom line is many of the changes are here to stay. You look at the preference changes in consumer behavior and how many retailers, close to 30 retailers filed for bankruptcy in 2020. And you still got around 10 million people unemployed. So these are not things that are going to change, after, for example, we roll out the vaccines. Many of these things are going to stay with us. So looking forward, what's the reopening economy have in store for us? And because of the permanent changes we just talked about, I think one important fact is we, at least at Global X, we believe we're not going to go back to the December 2019 economy. We still obviously have a COVID-19 pandemic around the world even today, with many places with cases flaring up, and you still have challenges ahead of you for the vaccine distribution. But that means, there's light at the end of a tunnel. And when schools and business do reopen, we believe certain consumer behaviors and policies are not going to go back to what it was in 2019, for example. So the focus right now is really how do we get from here to the new normal and what that new normal will look like. And certainly it's not going to be a linear path. And we're going to focus on safety and flexibility for people. So with that, I will, in the next section, me and Jay, we will dive into a few themes that we believe really stand to benefit from the reopening economy, as well as if you look forward to the new normal. So these are the 4 themes we will be highlighting today: cloud computing, Internet of Things, genomics, and telemedicine and digital health. So without further ado, I will start with cloud computing. And this is, as I kind of alluded to earlier, something we are probably more or less familiar at this point, given that we probably have had firsthand experience with many of these cloud solutions ourselves. But a typical question we come across is people asking, are we at peak cloud at this moment? How much further can these companies go? And if you look at, for example, the breadth of the industry, so we really define cloud computing as 5 different categories. You have software as a service, platform as a service, infrastructure as a service, data center REITs, that's also a very special area, and cloud and edge computing, which is arguably the next generation of computing technology. So it's a pretty broad definition. And in terms of what we have experienced firsthand, that might be a subset of all these businesses' capabilities. The other important data to keep in mind is how the decision makers, the IT professionals, are thinking about their spend and what they want to do with the cloud computing technologies. And you can see from the data points on the slide here, many people expect still significant investments and expenditure on this space. So when we kind of maybe switch gears and think about the business model of cloud computing companies, it's quite different than the traditional kind of IT solution providers. You have a lot of revenue based on a recurring model. And that's kind of what you can see upfront as a customer, not that the hidden costs maybe companies had to deal with before. So that's really attractive to customers. But to the cloud companies, this is also attractive business model because of the recurring revenue stream. And on the topic of revenue versus profit, one thing to also keep in mind is a lot of the expenses are fixed costs for these companies. So the marginal, when they grow the revenue, the marginal profits they're getting is pretty attractive for the cloud computing companies. So we've already talked about how these companies benefited from the stay-at-home economy. So when you think about what I mentioned earlier, the behavior changes and how people are not going to change those behaviors anytime soon, cloud computing is a prime example. When you have technologies entrenched in businesses and people's lives, it's not going to go away anytime soon. So if you look at this slide here, we talk about work from home a lot under this environment, and you can see how many companies obviously around the world have announced their policy on making that an option for employees, maybe on a permanent basis. And we also have seen from an employee standpoint how people are realizing this is beneficial to them and how they're likely going to do more in the future. And the other point of sticky business model, because of the recurring revenue, because of the reluctance for customers to change providers once they subscribe, the pricing power for these for these cloud computing companies are pretty great. So they could raise prices. For example, my personal experience, Netflix raised price in Canada and in the United States. And if any of you have subscribed to Netflix, you know that it's hard to, once you like what that, provides you on a day-to-day basis, it's hard to say no to maybe $1 or $2 per month more. So that's an example. But if you apply that to business, it's even more difficult when technologies are embedded into a lot of business operations. It's more difficult for them to switch, even when prices go up. So with that, I'll turn over to Jay to speak to some other themes that we're keeping a close eye on. Jay? My apologies. I think Jay is having some technology issues with the audio, so he's trying to fix that. So thank you for your patience. I'm sorry about that.
Testing?
Yes.
Can people hear me now?
Yes.
Sorry for the technology. Okay, people can hear me. All right. Well, clearly work to be done in the cloud computing space as we continue to work on this technology. The number of times I've heard, "Can you hear me?" In the last couple of months has definitely been more than I would have expected. Anyways, as Warner was saying, there's a variety of different themes that we think are very well positioned in the reopening economy, cloud computing being one of them. But there's other technologies that fit within this concept of flexibility and safety that we think is so important to this reopening economy. One of those other themes that I'll touch on right now is the Internet of Things. Just like cloud computing and just like the other themes that we'll talk about today, this was a theme that existed well before the pandemic. It was already experiencing very strong growth for a variety of different reasons, yet the pandemic has really served to be an accelerant for this technology because we're experiencing kind of new use cases for the Internet of Things amid this pandemic. As you can see on the chart here, these were expectations for the IoT's growth just pre-pandemic. You can see from 2019 to 2024, in just 5 years, the number of connected devices per person was set to more than double. As we see things like our cars, our refrigerators, our phones, our watches, everything's being connected to the internet. Now, there's a variety of different reasons why this is happening. There's strong consumer demand, there's improved internet coverage and speed, more commercial adoption, but probably most importantly is the falling costs associated with connecting things to the internet. Warner, if you go to the next page, you can see on the left-hand side here, the cost of the chip that went into the original iPhone, the iPhone 1, cost about $7.40 back in 2007 to put into that phone. Now, a newer version of that chip, not the state-of-the-art Wi-Fi chip, but another chip that can be bought today and connect something to Wi-Fi, costs about 10 cents and has the area 1/10 of the size of a dime. So you've effectively seen 99% price deflation in connecting something to the internet over the last 13 years. Of course, state-of-the-art 5G chips and Bluetooth chips might be a little bit more expensive than this, but if you want to basically connect something to the internet, it is virtually one of the easier things to do in product development these days because it's so cheap and because it's so small. It can be fitted into pretty much any device. Now we're seeing it connected to a lot of different devices, whether that's sensors being connected to your watches and wearables. Drones and autonomous vehicles are using the Internet of Things in huge ways, as well as robots, all of which have certain applications for the pandemic. But I'll touch on a couple of use cases if we go to the next slide. The first is using wearables for safety and flexibility. A wearable is effectively a watch, but it has multiple sensors attached to it, so it can monitor your heart rate, your blood oxygen, something like temperature, where you are. It can be fitted with a lot of different sensors, but I would say heart rate and blood oxygen are probably the most common. Fitbit, one of the leading providers of wearables, created a study early in the pandemic where they asked 100,000 different users who wear their Fitbit on a regular basis to just tell them if you have COVID. What they could do with this is they could start to tag the information that they were getting from each of those users in a new pool of people who had COVID, and they could start analyzing all of that heart rate data and blood oxygen data to start to understand, is there a difference in people who had COVID and those who didn't? What they learned pretty quickly was that through this, using artificial intelligence and through digging through this data, is that they could actually find anomalies in that data up to a day before the participant identified that they had COVID on their own. What that means is if your watch can tell you with pretty good accuracy that something's up, that something's wrong with your heart rate, something doesn't look great, that you should go and get tested or immediately start to quarantine, you can really slow the spread of this virus because it's one more day of preventing the spread with all the people that you would have interacted with otherwise. So if this study holds up and they start to apply this to wearables much more broadly, we could see that wearable data could be very, very powerful in limiting the spread of this virus. Now, secondly, we're also seeing IoT being used in public spaces as well. So not just on, not as a wearable, but in places like schools and businesses, using the IoT and connected devices to measure and monitor things like proximity, as well as to track the potential spread of the virus. Now, a couple of use cases come out here. One is if you go into the Global X offices today, which no one's required to go into, but there is the possibility of going in. You immediately effectively put your face in front of an iPad, which collects information about who you are, what your temperature is, and it stores that in a database. So that if you later go to tell the office, actually turns out I've been infected with COVID-19, they know everything about when you came in, where you were, what your temperature was, and can share that information with the office more broadly to help tell people, who may have come in contact with you that they should get tested as well. Similarly, what you see in a lot of offices and public spaces is that they're installing proximity devices, which effectively sit on the walls or ceilings of a building and measure where everybody is on a floor plan in real time. In doing so, it could send an alert to your phone if you get too close to someone else, or it can just collect this data throughout the day so that if someone then reports to their company, I have been infected with COVID-19, they can review all the data and see, here's all the people that you came in contact with over the last few days based off of that proximity information as well. So it's effectively digital contact tracing that's being implemented across a lot of different public spaces, again, limiting the spread of COVID-19 by telling people early if they may have been infected. If you go to the next slide, you can see that this is being incorporated in a lot of different areas. Businesses, airports, schools are all incorporating temperature checks and increasingly incorporating proximity devices as well to help make these areas as safe as possible for people that are still coming into these buildings. Now, the next thing I want to talk about that is also very central to the pandemic is genomics. Genomics is essentially the study of genetic data, the genetic level information about any sort of organism, whether that's a human or whether that's a virus. Similar to the Internet of Things, one of the reasons why genomics is becoming such a popular form of medical treatment and analysis right now is that the costs have declined substantially. Back in the early 2000s, it cost about $3 billion for the first human genome sequencing project. Now that price has gone down to about $100. As you can see with services like 23andMe, which can do an assay of your genetics and tell you if you like cilantro or not, and how tall you might be, and where your background is from, all that information that they're gleaning from your genetic data set. Now, because the prices have fallen so much on genetic sequencing, you see more and more people getting their genetics sequenced. That's more information that can be stored and analyzed. So instead of just looking at very basic things like male in their 30s to 40s based off of the East Coast of a certain socioeconomic level and trying to use that information to determine how you might respond to a certain drug or a certain treatment, they can use genetic level information, which is so much more finely tuned than the other information they've previously been using. On top of that, genetics can be used to do gene editing or gene therapies, where instead of using broad treatments, they can use very targeted treatments to potentially edit your genes at a genetic level to reverse a mutation that may have caused a debilitating disease. So it's really an exciting frontier in medicine that we're just seeing starting to take off right now. If you go to the next slide, you can see that it's technology that's been evolving for a few decades and has a huge potential addressable market beyond anything COVID-19 related. You can see that these medicines can be used in neurological diseases, cancers, various infections, the heart, liver, lung, basically all the areas that right now make up very large portions of pharmaceutical spending. But if you go to the next slide, we see that genomics has played a really integral role in the COVID-19 pandemic from the very beginning. The most important thing when this pandemic was first, or this virus was first identified, was to figure out what is this virus. And so the first thing they did is they genetically sequenced the virus, trying to understand at a genetic level what it looks like. Back in the early 2000s, when they did this for the SARS pandemic, it took about 6 months to do the sequencing of the virus. For the COVID-19 virus, it took about 2 days. What they did with that information is they could suddenly start, now that they know what the virus looks like, they can start trying to find copies of it in people's bodies by using testing. It's effectively doing kind of match the picture. This is what the virus looks like. Here's what we're looking for in people's bodies. If it's a match, you probably have COVID-19. So all of this all of this testing that we've been talking about for the COVID-19 pandemic has largely been a result of genetic sciences from the very beginning. We've seen that in the spirit of safety and flexibility, that testing has become much more widely spread, whether you see it in sports like the NFL, the NBA, the MLB. They're using testing as much as possible because they still have players playing games and traveling to some extent. And so testing is one way of quickly identifying whether someone might be infected. But we're seeing this rolled out to universities as well. We're seeing it rolled out to certain businesses like warehouses and food processing plants, where they also want to make sure that when people are coming into those facilities, that they are not going to be transmitting COVID-19 to anybody. So testing has become a huge part of this safety and flexibility approach. But beyond that, on the next slide, you can see that the potential cures for COVID-19, the vaccines and the treatments, are also largely using genetic-based approaches as well. One of the most famous ones today, the Moderna vaccine, uses an mRNA-based approach, which essentially puts the genetic information into the cells in your body to genetically, synthetically create that virus, and then your body can create the antibodies to fight it off. This is a completely different approach to vaccines that we've ever seen before. Previously, vaccines, they would basically just take a kind of dead or weakened version of a virus and put it into your body and let the autoimmune response happen naturally. This other approach is much more advanced and opens up many more new possibilities. Beyond just a vaccine for COVID-19, we're starting to see this being applied to many different potential vaccines going forward. One more recently that was just tested was multiple sclerosis, and potentially creating a vaccine for that disease as well. So mRNA-based approaches prior to the pandemic had been under research for many years. However, it lacked the funding and lacked the regulatory approvals necessary to start implementing it in widespread human use. Because of the pandemic, you saw money pouring into this space. You saw some of those regulatory hurdles being cleared, and now we have a completely new approach to medicine that's going to really accelerate over the next few years, and frankly could be one of the most exciting times in pharmaceutical development in a very long time. Now, the fourth theme I'll touch on similarly on the healthcare space is telemedicine and digital health. Again, a theme where the technology existed before the pandemic, was growing, but at a somewhat slow rate. For all the amazing mRNA technologies we see in healthcare, for all the robotic surgeries we see that are using the most cutting edge and impressive technologies, by and large, the healthcare sector is actually a pretty slow moving space, and is pretty slow to incorporate new technologies outside of the treatment space. If we think about the inefficiencies in hospitals and doctors' notes and administration and billing and all these things, they're still very much leveraging very old or non-existent technologies, and frankly, very much using analog technologies still. So this theme is bringing the digital technologies that we've seen take over the technology sector, increasingly take over the financial sector, and bringing that into healthcare, whether it's using video conferencing technology to use telemedicine, or IoT technology to remotely monitor patients, or applying digital techniques to data storage and processing to unveil new treatments for people, or better treatments, as well as making healthcare more efficient through healthcare administration, using digital technologies to have hospitals just run more efficiently and save on costs. So it's a space that's been, progressing, for a bit over the last few years, and could have a very large total addressable market as we rapidly digitize healthcare. But again, we saw it accelerate during the COVID-19 pandemic, as the pandemic really shook things on, flipped things on its head. I'll touch on this slide pretty quickly. More for the case for telemedicine and digital health. One of the areas where this is probably most attractive is one, making healthcare more affordable. So before the pandemic, and really before telemedicine really started to take off, it was pretty much standard, especially in the United States, that if you had to go see a doctor, you would get in your car, you would drive to the doctor's office or the hospital, you'd wait in the waiting room, you'd see the doctor, they'd see you for 5 minutes, they'd send you back on your way, you drive home. It was inefficient, it was expensive, having people come in constantly and having to clean. It wasn't safe because you're exposed to other people who are sick in the office or in the hospital. So it didn't really make a ton of sense. Why would you have to go to the doctor for a pretty routine visit, or just to simply have a consultation with a doctor, or have a prescription renewed, or something very simple like that? So telemedicine, just by cutting out all those different steps and allowing you to use the technology we're using right now to meet with a doctor, could be very beneficial. And beyond that, it can extend medicine not just to people who can't afford current practices, but can also extend medicine to people who are in a very rural area who maybe don't have that much access to doctors. Maybe the closest doctor or the closest hospital is 2 hours away, and so they're not going to go for that consultation. But now that they can use telemedicine, it's expanding the reach of healthcare to a much broader audience, not just through cost, but through accessibility as well. So it's not just taking over and expanding, the existing addressable market, but expanding upon it for healthcare as well, which we're very excited about. As I've mentioned, in the pandemic, we've seen a huge acceleration in telemedicine. Healthcare is a slow-moving space, but there was really no choice during the pandemic. It was so unsafe for people, especially seniors, to go and see their doctors, even though they needed to, because of the risk of infection. So you saw a lot of these healthcare providers very quickly implement telemedicine services, which really kind of helped it jump the gap, or cross the chasm, as we sometimes say in thematic investing, where it went from a very niche technology that was really not very widely used but across patients, to something that's increasingly used across millions of different patients, especially in the United States, but increasingly globally as well. So it took, the technology existed, the use case for the technology existed, but it took that disruptive environment to really cause greater adoption. Of course, we're seeing some normalization of telemedicine after the surge in April, but we're continuing to see much more elevated usage of telemedicine going forward, and we expect it to continue a long-term growth trajectory as healthcare providers implement it, as doctors get used to using it, and patients get used to using it as well. So I think we already touched on this, but beyond just the video conferencing aspect of telemedicine, the implementation of digital techniques can really have huge improvements across the healthcare space. You can see all the different areas where there's inefficiencies in healthcare in the chart below that we think digital techniques can help improve. Just like digitalization changed brick and mortar retail and has changed financial services into something that's much more online based instead of in branch. So we think there's very exciting times ahead. I'll leave it here with key takeaways and then turn it back over to Warner. We saw a lot of structural changes accelerate during the pandemic. Warner touched on e-commerce and video games and esports and cloud computing as these areas of the economy, were just much more widely used in the context of not being able to go outside. In this reopening stage of the economy, however, the emphasis is really on safety and flexibility as governments and businesses really try to, understand what's happening in COVID-19 and try to somewhat reopen the economy while also being safe and protecting their constituents. The areas that we see as having been being very well positioned and continuing to be very well positioned in the future are cloud computing, the Internet of Things, genomics, and telemedicine.
Great, thank you very much, Jay. So with that, I'd like to just highlight a few resources.
Warner, I don't know if it's just me, but now I can't hear you.
Oh, let me. Can you hear me? Test. Can you hear me?
We can hear you, Warner.
Okay, great. Okay, so just back to my, the slide in front of you right now. I just want to highlight a few things for everybody on the line here. So we, as I mentioned before, Global X, we do produce a lot of research content. So you can find most of that on our website, globalxetfs.com/research. But also you can follow us on Twitter. So here are some handles that you can check out from Jay as well as our analysts. And, obviously feel free to reach out to me if you have any questions or comments. I'm your, dedicated Canadian representative, as Graham mentioned earlier. So would love to just chat with any of you individually offline if you'd like. So with that, I will pass it back to Graham.
Yes, thank you very much, Warner and gentlemen. Very informative and enlightening. Particularly like the genomics area there. I don't know about all the privacy and ethic issues in regard to the genomics, but maybe that's something that people are still struggling with right now. So we're going to open it up for questions, and you can please use the chat function, or if you have any questions, unmute, and we can start with that. One of the questions is, can we share the slides? Yes, we will have access to those on our, and we'll be able to provide those to you, absolutely. And that our administrator mentioned, yeah, that's right. So the slide deck will be available after the webinar through an email. So let's open it up. Any questions? I can get things started. You spoke about, I was just wondering about Warner, about your products. So the ETFs now, how encompassing are they? Are they all those fields we talked about? Is it each particular field I could buy an ETF for? And what is the depth there in each ETF?
Sure, great question. Just quickly, can people still see the slides, or are they stopped now?
They've stopped now.
Okay, I'll just go back maybe if I may, and then show you one slide here that'll help answer this question. So we have, I think I mentioned this briefly, we do have the largest number of thematic ETFs, among all these ETF issuers. So you can see on this slide, hopefully, the products that we have. And the idea at a Global X is to give investors pure exposure to every individual theme that we believe are, again, powerful and long-term in nature. So each of these ETFs essentially track an individual theme, and then we very much want people to invest based on their preference, based on their views. They can obviously pick one theme or multiple themes, combine them. So we see investors do two things differently, but we essentially are providing you the toolkit or the building blocks for that approach.
Perfect. We have a couple of questions. Someone's raised their hand, so I'll allow them to ask their question. Please go ahead. We'll start with Alex.
Is this, thanks for unmuting. Is this, can everyone hear me all right?
Yes.
Perhaps not. So I was just typing my question here. So I think that'll, I'll send it in through the Q&A if
Okay.
I can't be heard right now.
Yeah.
Thanks.
Because I
can hear you. Yeah.
Okay, while we're waiting, Tim has a question. Which areas might have the most and least downside to the reopening economy? It says, I might guess electric vehicles and lowest downside to reopening economy. Genomics may take a dip post-COVID. So I don't know if Warner or Jay, you want to answer that one? Which areas might have the most and least downside to the reopening economy?
Sure, I can take that, and Warner can share his thoughts as well. So, upside and downside with the reopening economy, and I think the ones we shared are the ones that we think have the most upside with the reopening economy, because they're most directly linked to what's happening in the reopening economy right now. The fact that we're trying to balance, safely reopening the economy as well as protecting people, we think very much lends itself to the IoT and cloud and genomics going forward. As well as telemedicine and digital health. Most downside, it's tough to say. I mean, we haven't looked at the areas that we think are going to benefit the least. I think there's just some themes that are not particularly correlated to the reopening economy. So electric vehicles, not a huge driver, no pun intended, of the reopening economy. People will buy electric vehicles because the costs are coming down. People will buy electric vehicles because because personal savings is increasing, so there's more opportunity to buy, big ticket items right now. But it's not really, aligned with the reopening economy itself. I think these are longer term trends that are focused on the electric.
Oh, so it seems that the audio is getting through. My apologies. So I guess the question would be, firstly, thanks for the presentation. I think you guys have made a very strong case for the growth in each of the four themes that you've outlined in the reopening economy. So my question would be how would we relate these themes to investments? So how are you capturing these, I guess, determining, which companies go in which buckets? And then from an investment standpoint, how should we value these themes? It looks like if you look at kind of top line fundamental valuation metrics, which may or may not apply here, that these would be, extremely, far from historical averages or anything else out there, notably for these four reopening themes. So I'd be very interested to hear your thoughts on that. For investors that would be interested in wanting to be, I guess, reassured from a valuation standpoint.
Yeah, I can kind of take that and obviously let Jay weigh in if Jay has more thoughts on this, but maybe kind of go back in order of your questions. The valuation topic, I think obviously a lot of investors have asked that and in the past months or even year. One thing we stress at Global X is really to look at maybe non-conventional measures when you look at the valuation for a lot of the themes and a lot of the companies within the themes. We actually published this monthly report, this newsletter online, and I can share with everybody the link to it in our resources later. But essentially, we have a standard monitor on what we call the evaluation adjusted for growth measures. So if you think about your traditional, for example, price to earnings or EV to EBITDA, none of those account for future growth. So one thing you could do easily is just take the projected growth of sales, for example, and divide your valuation metrics by the projected growth to get a more holistic view of the valuation. Now, the other thing is, in terms of, for example, sales versus profit or earnings. So we do believe that, for a lot of these companies, especially the smaller ones, they are not strictly focused on generating earnings or make a profit on the income statement, but rather grow their business, get more users. So you might see growth in top line, but not necessarily the earnings. So sales, in our opinion, sometimes reflect a better picture in terms of the runway and how much upside potential the companies have. So those are two thoughts there, but I will share the resource in terms of our valuation metrics that we use. Going back to your, I think, first question, Alex, about the kind of the approach or the process we take to translate these themes into tangible products. So, I touched on the three, I think on the slide here, the 3 steps we look at when we launch any theme in an ETF structure. And so very importantly, we want to look at the investability. So that's number 2 on the slide here. So that means you have to have a broad basket of companies publicly traded. So how do we select these companies? Sometimes we work with in most cases, actually, we work with an index provider to have a very unique, definition for the index, right? So none of our ETFs are tracking quote unquote standard indexes. They track more unique, more bespoke indexes underlying them. And sometimes we use, for example, AI or a subset of AI. It's called the natural language processing, for example, a technique that can help you identify the business models of companies and what's driving their revenue, what's driving their growth. And we apply that to certain themes that we track to help us identify, what companies are actually playing in that arena.
Perfect. We have a few questions that came up through the question and answer. One was, just want to know your thoughts on the concept of climate change and as a significant theme going forward. And we didn't, I'm not sure if you mentioned that in your ETFs.
So I can take a stab at that, I think it's very interesting. It's a very obviously very hot topic. Call it sustainable investments or ESG or different monikers people use. But in our view, really the sustainability is a more overarching trend that is probably impacting a number of different themes that we have that we're tracking here. So as a matter of fact, we are going to have a piece coming out pretty soon. The intersection of thematic and sustainability, but strictly if you narrow that to climate change, obviously clean tech. So that's one of our relatively new launches in this space is very squarely sits in that kind of climate change and the solutions trying to address that. So that's been very, very popular as a topic as well as an investment choice. And we, from the Canadian standpoint, you probably know that there's a number of products or launches in the marketplace, but our take on that is quite unique because we try to really focus on the tech aspects. So for example, you don't have any exposure to the traditional utility sector when you look at the underlying holdings of this fund versus many other comparable funds may have way bigger exposure to the utilities sector.
Perfect. Thank you. The another question came up regarding valuations. So I was just wondering, do you feel that these are pretty stretched right now, the valuations in most of these companies, because this has been going on it's been about a year now, we're starting to see that. So I was just wondering, all that money that flowed into these companies, how stretched are these valuations?
So I kind of shared my thoughts on that a little bit, but Jade, if you have maybe something to add here and just expand on that.
Yeah, as Warner was mentioning, high valuations are justified by high growth. As long as these companies deliver on the growth expectations that are set on them, which are, albeit very high from the market, then we don't see the valuations being a challenge. I mean, simply if you're looking, we prefer to look at price to sales over price to earnings for these high growth themes. A lot of these themes are still growing, double-digit revenue growth. Social media growing at 20%, expected to grow 20% this year. Cloud computing expected to grow about 15 to 16% this year. Very high growth. Genomics expected to grow about 80% this year. So when you have really high revenue growth, we get less concerned about the actual valuations ascribed to those companies, and we get more concerned about whether those growth expectations can be met. Because we've seen such an acceleration in the adoption of these technologies during the pandemic, and because we expect a lot of this acceleration to be sticky and persist beyond the pandemic, we're not that concerned about valuations. However, if that proves to not be true, if you see a massive reversal of, suddenly people stop using e-commerce, or mRNA vaccines get, shut out by the FDA by the end of the pandemic, that can definitely present some issues. So it's more a bet on growth than it is a bet on, valuations normalizing. With that being said, people obviously, sometimes are looking, from a valuations perspective first. There are some themes we have that are, kind of cheaper from a valuation perspective. It's not going to be cloud computing. It's not going to be telemedicine and digital health. But areas that are a little bit less in the software and technology space tend to have lower valuations. So US infrastructure development is one theme of ours that on a price to sales or price to sales to growth measure is pretty low. Similarly, our health and wellness ETF has pretty low valuations as well, because it's just not really in the technology space. So if people are trying to bargain hunt right now, it's certainly not going to happen in digital technologies, but there are some areas that have lower valuations within thematic.
All right, thank you. We're almost at our time here at 1 o'clock. However, I got one more question from Dennis. What are the potential barriers to widespread adoption of wearables for health monitoring? Similar to vaccines, many people would choose not to share their personal health data. And how can companies and governments nudge consumers to adopt these technologies?
Yeah, it's a great question. So what happens a lot of time behind the scenes is that it becomes anonymized, especially to be HIPAA compliant, which is the US regulations for privacy with healthcare. So when you look at like a Fitbit study or you look at digital healthcare, a lot of that is taking data and taking certain information about that person, but anonymizing it. So if it takes my data, it's going to say my age, my gender, and where I live, and it'll take all that information, but it'll scrub my name away from that data so that it can be HIPAA compliant and can be pooled with other data to be analyzed to infer interesting things from that information. So what will be interesting for wearables is how much these companies like Apple and Google and Amazon want to be, HIPAA compliant, or if they want to stay kind of a consumer technology company where privacy concerns are a little bit more lax. I would guess that their preference is to not dive too far into the HIPAA world if they can avoid it, because these companies have not proven to very much enjoy regulation in the past few years. But with that being said, if they want these wearables to really take the next step and be considered really medical devices, that's something that they'll have to do. So it'll be an interesting inflection point. In the meantime, what accelerates consumer adoption? If we look at the adoption curve, it's still early in wearables. It's not, widespread that people are wearing smartwatches yet. I think it's still less than, I think it's about 15% penetration in the US. So, what spreads it? Part of it is the technology gets better. Part of it is the technology gets cheaper. And part of it is kind of the evangelism aspect of people who have those technologies telling their friends that it's cool and it does all these things that they want it to do. So in some ways, the more people that buy an Apple Watch, the more it's going to accelerate future growth, because you have all these people who are wearing it talking about how many steps they did and how many calories they burned and how it saved their grandmother when she fell and it detected a heart anomaly and alerted the authorities. That's the kind of stuff that helps propel adoption much faster.
Not only that, but an Apple Watch, you have to have the iPhone in order for it to function. So there's a nice link there to their other products as we go forward. So thank you very much, gentlemen. Very, very informative webinar today. I want to mention before everybody leaves, just a quick reminder that our next webinar will be February 17th with Mr. Ali Nasser from Virgin Asset Management. And he'll be discussing opportunities and risk in frontier and next generation emerging markets. So should be quite informative as well. So I want to thank everybody for coming today. Gentlemen, thank you. And have a great week. Thanks, everybody.
Thank you all.
Thank you all. Take care.